And we turn now to our second installment of our Fed series with a look at how does the Fed know when to raise rates. There is concern that if rates are raised too quickly, the economic recovery may stall. Alan Sinai, CEO and Chief Global Economist at Decision Economics. He has almost 30 years of economic experience, and we're pleased that he's joining us now from Boston. Welcome to you, Alan.
Nice to hear you, Lori.
I want to pick up our discussion on interest on execs reserves. What do you think of this idea to replace the old benchmark of using the old Fed interest rate?
No, it's superior and gives the Federal Reserve a lot of options. The federal funds rate and other short-term rates may rise when they raise the rates on excess reserves. And, of course, the banks will have a lot of options what to do with those excess reserves, which have to be drawn out of the banking system. They're sitting on top of a huge amount, and it has potential latent inflationary pressure should they aggressively lend it out, which, of course, they're not doing now, and they no chance in the near term that they will do that.
Do you think that's the best option for exit strategy?
I think using that rate as the lever is the way to go, and it's a very ingenious invention of this Federal Reserve to hone in on that as the rate as they exit. The funds rate still is going to be very significant, as noted before. They can raise them both at one time, and they probably are going to still use the Fed funds rate as a signaling mechanism as to where they're headed on policy.
So explain, if you will, and Michael McKee, our economics editor, touched on this too, that if you let the Fed funds rate trade with some spread to the interest on exits reserves, what it'll mean for markets and if there are benefits to that.
Well, for banks, they're going to be able to decide where they get the least cost for funds that they might lend out, and so it's helpful to them. I think for short-term rates in general, whichever way the Fed goes, when they start to raise those rates, all short-term rates, including money market rates, will go higher, and investors will get a higher return.
Now, how would you orchestrate the IOER and the Fed funds rate? How should the Fed determine the timing there?
They've told us what they're looking at. They've told us that they're going to keep rates low for an extended period of time. I think that's what they'll tell us tomorrow in the statement. And the reason is the three conditions that they have set out in their statement, namely the slack in the economy, principally the labor market and the unemployment rate, the trend growth of inflation, which is really the core rate. That's what they're looking at. Whether we like it or not, that's what they're looking at. And inflation expectations. Those are the conditions that will tell them when is the right time to start to raise short-term rates. The right time, quotes around that word, that's the operative phrase. They are right now focused on the slack and the tremendous amount of joblessness and unemployment. There isn't an inflation risk from their point of view that they're worried about, so they're just going to stay with zero rates for as far as the eye can see.
All right, so if tomorrow's announcement rather, turns out to be a so-called non-event, is that really a bad thing, given the markets have been a little volatile the last couple of days?
It's not a bad thing at all. You know, for stocks are all about earnings and interest rates. So very low interest rates set by the central bank with a message that they're going to keep it that way for quite some time makes cash and equivalent a terrible alternative for investors and directs funds into the stock market, helps to prop stock prices up. And that, in turn, is going to help out consumption later on, because higher stock prices mean higher wealth, means some capital gains realizations. Consumers may spend some of that money. It's supportive to the economy.
Bernanke, as you know, has been highly criticized of late. There's been some doubt that he'd be confirmed for a second term. We've been following the senators sort of marching one by one, announcing their intentions. 46 say they will vote for Bernanke's confirmation. 19 say they will vote no. What do you think at the end of the day? Will Bernanke be confirmed for a second four-year term?
Oh, yeah, absolutely he will. I think we're getting a statement of protest and concern playing to the, justifiably angry American electorate in terms of all of the help that the major financial institutions have gotten when we have a lot of so-called ordinary people without homes and without jobs. They're obviously very angry. So I think the senators and the House of Representatives make their protest not so much that they're against Bernanke, but to play to the audience that they have to play to. And I think at the end of the day, he's easily confirmed.
Many thanks. Our thanks once again, Alan Sinai, the CEO and Chief Global Economist at Decision Economics.